Let's get you all the business news now. And markets snapped 2 days of gains after opening higher. Consumer durable sectors and financial services sector was the top gainers. Metals were under pressure. Hiral Dadia with a wrap of all the market action.
A pretty somber day of trade is what we witnessed in the markets after 2 consecutive sessions of rise. Clearly, you have Nifty 50, which has ended below the 19,600 mark, and Sensex as well, so cuts of nearly 100 points coming in there. It was interesting to see how Bank Nifty has outperformed the benchmark indices in trade today, and this is ahead of the RBI monetary policy that is slated on the 10th of August. Overall, it's the PSU banks that have actually supported the Bank Nifty in the overall session. The advanced decline ratio as well has been in favor of the bears, so that's going to be an interesting aspect that we continue to monitor. Overall, if you go to see, except the banking and the pharma pack, all the other indices ended in the negative, and it was the metal pack which was the top losing sector as well. Moving on, if you see in terms of the top gainers, you had names like Hero Moto, SBI Life, Cipla, Tech Mahindra as well as a Wipro, whereas on the losing end you had names like Adani Enterprises, Hindalco, Divis Laboratories, M&M as well as a JSW Steel. In terms of newsmakers, Adani Ports reacted to numbers which beat street estimates, as well as Maruti Suzuki has decided to go for a share swap for the Gujarat plant, and that will see a 4% equity dilution as well. Moving on, in terms of other newsmakers, you had a TCS that was in focus in today's session as well, and this was mainly on the back of the deal that they have got from GEM. Apart from that, Inox Wind saw a block deal in trade today. Genus Power was in focus on the back of an order win. Gland Pharma reacted to numbers and was locked in upper circuit. GIC Housing Finance was down in trade on the back of numbers. And you had a Tata Power on the back of an order win that was in focus. So overall, if you go to see a lot of newsmakers in trade today, it's a day where there is some bit of consolidation that has continued, but it's mainly the financials as well as the rate sensitives that will continue to remain in focus ahead of the RBI monetary policy that is slated, as we mentioned, on Thursday. That's all. Back to you.
Now let's shift focus to sectors you can bet on for healthy returns. Sugar stocks have been rallying in the past 1 month. How will they fare this earnings season? Is there still an upside in the pharma space? Anshul Sehgal of Kotak PMS shares his views.
I'm too used to calling sugar companies, but they are no more sugar companies. They are actually ethanol companies which also do sugar, and sugar is an input into the ethanol business. Here, I think that the dynamics of that business has changed so dramatically that we will see both earnings uptake as also we will see multiple expansion in this space. And this will play out in our judgment over the next 2 to 3 years. And when the street sees that earnings are consistently on an upward trajectory, these companies which are trading at 6-7 times earnings, they will have no room for the multiple to go but up. And so our belief is that that this space will do well. Pharma, I think what played out over the last 6-7 years, in fact, this segment of the market has gone nowhere for the last 7-8 years. And here, what we are seeing is 2 interesting things which you can't really put on Excel sheets for now. It is just a judgment call, which is that there are shortages on US racks of generics. And at the same time, there are significant price cuts that the regulator over there is imposing on many of the exporters of generics from India. Now, both things can't go on indefinitely. For shortages to go away, prices have to go up because it has to be remunerative for companies to actually go out and manufacture. And our belief is that that cycle is going to play out now. Over the next 1 to 2 years. If that is the case, where companies have consolidated over 6-7 years, we will see multiple expansion. Some of that we have already seen, but our belief is that there will be further tailwinds to this multiple expansion, particularly in exporters to the US. India business of most companies continues to do very well.
The government last week introduced licensing and ended free imports of IT hardware. But what is the rationale behind the move and the potential impact of the measure? Are Indian companies ready to expand capacities? Saurabh Gupta of Dixon Technologies shares his company's plans.
It's a large opportunity. If you look at the overall market, it's around $9 billion, and clearly it's a growing market in India. And eventually over the next few years, it will be a $13-14 billion market. So my sense is we are a large player and we are a beneficiary. And of course, we will now apply under revised IT hardware PLI scheme, and we will be very aggressive in applying for that. So as of now, in our scheme of things, we are manufacturing for Acer. We expect that our volumes with Acer will go up. And we are also in discussion with large global brands. So clearly, we think that over the next 6 to 8 months, we will increase our capacities. There will be stabilization phase, ramp-up phase. And by next financial year, we'll start to have meaningful revenues in this particular category.
While Paras Defence saw an 18.5% jump in revenues, net profit took a hit and margins contracted considerably. However, R&D Director Amit Mahajan is not worried about these numbers. Listen in as he explains why the margins took a hit and why their yearly numbers won't be impacted.
Yeah, the margins went down because if you look at from year to year, we have got a huge investment done into our own manpower. So our employee benefit costs have risen. Why? We want to take care of our employees, which are the engines of our growth. Second, we've also onboarded some very, very professional team members who will then not just carve the near future, but also will be very strong contenders as the stakeholders in the growth to come. So we have done investment into our employees, and hence there is this quarter we may see something like this. But again, you will not have any of this effect coming on to the yearly performance of the company.
Why do you say that? Let's talk about that.
Because not just we are envisaging a better revenue, but also a better profitability. So when you look at it from a yearly or a Q1, Q2, Q3, Q4, all quarters put together, the employee cost which has risen in Q1 will flatten out over the period of the time.
And that's a wrap of all the business news.